today is gold, and that is now trading at a record high level. In fact, today it is up 0.5% and it is gaining for the sixth consecutive day today to trade near that $3,500 per ounce mark. Now remember, there are expectations of Federal Reserve rate cut in the meeting that is scheduled to happen later this month, and most of the analysts expect a 25 basis point rate cut, and that is leading to the up move in the precious metal market. In dollar terms, in calendar year 2023, gold rose by nearly 13%, followed by a 27% uptick in the last calendar year, and this year so far gold has already inched 31% higher. So that's the kind of up move that we have seen in the global market. Remember, several factors continue to remain at play. One, of course, is escalating geopolitical tensions because of the kind of uncertainty that is playing out with respect to Russia-Ukraine war, and that is aiding safe haven demand over the last few days. Apart from that, strong demand from central banks also continues to be one of the triggers. But remember, despite the kind of up move that we have seen, brokerage houses continue to remain bullish. Now, for the fourth quarter of calendar year 2025, Goldman Sachs has given a target price of $3,640 per ounce, JP Morgan at 3,675, and Morgan Stanley, they are even more bullish at $3,800 per ounce. That's the target price that they've given for the fourth quarter of this calendar year. So yes, brokerage houses continue to remain bullish and gold is at an all-time high in the global market. But will the momentum continue? To understand that, we are now joined by Anindya Banerjee, Senior Vice President, Head of Commodity and Currency Research at Kotak Securities. Anindya, thank you so much for taking your time out and joining us here on ET Now. If you can tell us if Federal Reserve expectations of 25 basis point cut is the only reason which is aiding the up move in gold, or is there some other factor? And from 3,500, what will your next target be for the yellow metal?
A very good afternoon. Thank you for having me. Yes, the Federal Reserve expectation is definitely one of the factors, but let's step back and look at the larger structural factors at play. It's basically the de-dollarization or the dependence on dollar as a major reserve currency. I think that switch is what has been driving the demand in gold for some time now. It's been a few years. The central banks have been allocating more and more towards gold. The institutional investors have been doing so. And at the current juncture, if we look at the Western economies, US, major economies in Europe, the trend is simple. The economic conditions are precarious. The debt is out of control. Fiscal deficits are running at wartime highs, and there is no sign of they being controlled. And plus, if I look at America, where now their central bank independence is at threat. Plus, if I look at America first as an industrial policy, then it's clearly means where US is trying to become a producer from a consumer. The least thing that they would require is a significant dollar devaluation over the next few years. So this is a perfect storm which is going to hit the US dollar, and that's the reason why which we are seeing is a lot of allocation towards gold and silver as well. So that is the larger picture, what is driving the gold prices higher. In the short term, of course, the Fed interest rate expectation, slightly weaker dollar, geopolitical tensions are additional factors.
Yeah, so then what will your target price be in the short term and in the medium term? So for the rest of this calendar year and for 2026 as well, what will your target be?
Right. In the short term, the prices have come out of a 3-4 month consolidation or time correction. So 3650 to 3700 is our target over the next couple of months. If I look at by December end, then it could be closer to 3,800. For next year, we could see an even bigger jump, because from next year onwards, we could actually see a much weaker dollar, which can push the gold in dollar prices towards possibly $4,500 or higher. So that is the overall expectation in gold.
Is there any downside risk to your estimate if at all geopolitical tensions were to ease and Federal Bank, say for instance, does not go ahead with that 25 basis point rate cut? What kind of downside risk do you see to this gold estimate?
Right. See, geopolitical tensions have been always a short-term factor, which tends to go in and out in the market. But the bigger risk to gold would be if there is a big sell-off in the equity markets, like we saw in April, and that leads to a margin call across all asset classes, right? So in that case, people will be forced to sell not what they want to, but what they have to. So that's exactly is a risk which I have to watch out for. But having said that, that can create temporary dips because the bigger structural story is intact, and that is bullish for gold.
And Anindya, if you have to contrast gold versus silver, because silver too is trading at the highest level since 2011 at about $41 per ounce. Of course, the lifetime high is still far away at $49 per ounce. But what will your view be when it comes to silver?
Right. Actually, silver is a very interesting play. It's basically a dual play of both de-dollarization as well as the industrialization through the new economy, electronics, the smart electrical grids, etc. And this market has been in a deficit for the fourth year running. So, which means that the silver prices, in our opinion, has a bigger upside than gold. And interestingly, it has actually stalled twice at the level of $49 an ounce, once in 1980, another time in 2011. We expect that to be eventually crossed, and silver prices over the next few years can even aim towards the level of $80.
Okay, so $80, that's a big target coming in for silver, and you continue to remain bullish on gold as well. Anindya, thank you so much for taking your time out and joining us here on ET Now, especially on a day like this when gold is at an all-time high and silver too is trading at the highest level since 2011. Thanks so much for joining us today.
Thank
On
you.
that note, we need to slip into a very short break, but more news and updates will continue on the other side.